Hello and welcome back to the Note. We've had a frenetic end to the week which leaves the S&P 500 almost completely uncorrected. It now needs to rise less than 3% from where it ended today to get back to the record it set back in May. What's interesting, however, is how it got there and the effect that the big forces moving markets at the moment have had elsewhere in the world. Now, there's no question what the biggest news today was. We're illustrating it here. We had a further cut in Chinese interest rates from the People's Bank of China. Those rates, as you can see, are still far higher than they are in Europe or the US, but it's still fascinating to see how low even China's rates have come by their own historical standards. They are plainly very concerned to stimulate their economy. If we take a look at the other big measure that the PBOC uses, the Bank's Reserve Requirement Ratio, another direct way in which you can make it easier for banks to offer credits to the economy, again, you can see that that measure is as easy as it has been almost since the crisis. Another move announced overnight. What is interesting, however, is who has benefited from that and who hasn't. If we take a look at how emerging markets have performed over the long term compared to developed markets, they've actually slightly underperformed the last couple of days, even though big new Chinese stimulus is plainly very beneficial for emerging markets. Yes, they have rallied relative to the developed world in the last 2 or 3 weeks, but really not by very much. The ongoing trend to force down emerging markets remains very much intact. That's true of their stock markets and of their exchange rates. Now, if we move on to take a look at metals, which is plainly very central to the Chinese story. China is the great demander, consumer of metals at the margin. Similarly, with all the excitement in the last few weeks about extra stimulus, easier money from central banks, no impact whatever on the metals market. There is no great sign of renewed optimism there or of renewed activity there. Very intriguing. Let's take a look instead at where you do see a very big effect, and this is the American stock market, the S&P 500, compared to the FTSE Euro First 300. Last year, there was an extraordinary run-up of the US clobbering the European stock market. Many people, myself definitely included, expected to see quite a clear-cut reversal of that this year. It hasn't really happened. QE, which appears likely to be intensified in Europe later this year, should boost European stocks that much more than American ones. However, that's more than cancelled out by the effect on the exchange rate, and you can see that as it stands at the moment, by far the biggest beneficiary anywhere in the world from the easy money that we've had announced this week from China and virtually promised from the ECB, the biggest beneficiary has continued to be the USA. I don't know what our many viewers around the world will think of that, but it seems still to be the case. Money is fungible and it flows towards the USA when it is able to flow. Next week, we will get a very interesting look on this because we will be hearing from the Federal Reserve. It's highly unlikely they'll actually move interest rates. It would be a huge story if they did, but we should get a very much clearer grasp of their intention after their meeting next week. We will also hear a lot more from corporate America. But as it stands for the moment, the bottom line from this week is that America still rules okay.